Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. We're on a mission to become Australia's most trusted property podcast. This is our weekly 2 cents segment where we take a plain English look at the big three property news stories of the week. This week, I'm joined by Mr. Owen Rask. Welcome, sir. How's your week been?
Thanks, mate. It's been great. I always love bringing down the average on the show, so I appreciate you having me on.
Well, the average age, yeah. Did you have an earthquake in Melbourne this week?
We did, but I managed to dodge that by being on an airplane. So I was flying to Sydney, so I was okay. But yeah, we had an aftershock as well just yesterday, and my wife slept through it. So yeah, we didn't really feel it, but apparently it's a big one.
I hate those. I used to live in East Timor, where obviously they get quite a lot of earthquakes, and the building rates probably aren't quite the same as in Melbourne. It used to make me very twitchy. Also, went to a wedding in Christchurch where we were staying probably the only hotel that remains with 10 or 12 stories. And I was pretty pleased to leave, to be honest, the amount of earthquakes that they've had. But Melbourne's usually pretty light on, I guess.
It is. And you feel for anyone that's in those places like Christchurch. It's a pretty harrowing experience.
Yeah, the rebuild has taken forever. I was really taken aback by how long that has taken. And obviously urban planning to take into account as well. So, thanks for joining everyone this week. So every Sunday at 7 a.m, you will find our 2 cents podcast episode waiting for you in your podcast player. These are a bit of fun where each week we cover the big three news stories of the week. We sometimes throw in a few of your questions as well. So always send us your feedback and questions, and we'll try and weave those in as we go along. So anything else, Owen, before we kick off?
No, I'm just going to ask you how your week's been.
It's been good. I've been actually over in England this week. Some really nice early summer weather. I've actually been at the beach a fair bit, so trying to top up the tan. But I know this sounds completely ridiculous, but you remember about 2.5 years ago, I got stuck overseas during COVID, couldn't get back into Australia, so we ended up buying a beach hut, which is kind of crazy. I've never been in a beach hut in my entire life, but I just bought one on a whim. I guess I figured it'd be something that might hold its value. And but now, of course, I'm trying to get the kids to use it at every available opportunity to get our money's worth. So
that's great. That's great.
In fact, there's so many people actually doing staycations now instead of going overseas. The demand for coastal property and these kind of things has gone through the roof. There's just not enough caravans, not enough places for people to stay. So I think it's the high airfares and high energy costs are keeping people at home a bit more. So it's interesting times. It's been a strange few years in no end of ways, and I guess that's some of the stuff we'll talk about this week. So I think these are the three big news stories this week. So firstly, land tax pains. Victorian themed news piece this week. The Victorian budget has gone pretty hard against property investors. So we'll talk a little bit about what that might mean for your portfolio. Secondly, build to rent. It's practically every day I log on and there's another build to rent story. Different players coming into the space. And I think a lot of people don't really have a handle on what the build to rent sector means and what it's going to mean in Australia. So let's talk a little bit about that. And then thirdly, the listing environment. There's just so little good quality stock on the market for sale. So we're going to have a bit of a deep dive into why more people aren't selling and when that might change if it does. So does that sound okay as a bit of a rundown?
Yeah. I actually, I think maybe just to quickly chuck something in here, Pete, we did have a question that came through. And it was actually a question delivered to you, mate. There were some lovely words. Someone said they love your thoughts. And they said they own a few investment properties in Victoria. They've got some young kids. And their original plan was to pay off all the property debt and then just have the rental income, I guess. But they've said in a question, they basically said with all the new investment property changes, laws, taxes, they've pushed us too far. And it just doesn't seem to add up anymore when I compare it to the other asset classes. And that's even with a confident assumption of good capital growth in property into the future. Pete, I'd love your thoughts on this. Do you ever think about this for yourself? Do you think the pendulum will have to start to swing back in favour of the landlord if these changes continue to plague the rental crisis? So this is obviously related to some of the changes that we saw with the Victorian budget and the changes that have come. So that's a good framing for the real world experience, I think, of what we're about to talk about.
Yeah, I was just smiling there because I saw you abbreviated the full comment. It said, Pete, I love your thoughts because you're a rare unit and you're so open and educated on all asset classes. I've never worked out whether that's an Australian slang insult or a compliment. I'm going to take it as a compliment.
It's a compliment, a rare unit.
Yeah, in a good or bad way, I don't know. So why don't we have a look first at what the changes announced in the Victorian budget were, and then we can relate it back to the question from Dan who wrote in there. So thanks Dan for the question. So yes, okay, big picture is Victoria government has had a budget in deep deficit for some time, big debts in Victoria. It wasn't helped, of course, by the pandemic, which impacted all of the states around Australia. And we've had this ongoing issue that the mining and resources states in Australia often bring in big revenues and tax revenues, but New South Wales, Victoria have had various issues in terms of debts, and New South Wales has tackled it with some asset sales. So the Victorian government is introducing a higher land tax for property investors. So essentially, property investors will be slugged with extra land tax charges. So from the start of next year, there'll be a $975 annual fee on land holdings of more than 300K and an additional 0.1% for every dollar of land value above that. So the threshold for land tax is also to be lowered from 300,000 down to 50,000, so it captures more property investors. So I guess I guess the thing here is it's just a push really to bring the budget back after some significant debts that have been run up through the COVID pandemic. I think there's always a bit of a timing issue with these things. I think when the rental market is soft, then there might not be so much impact on the rental market because there's plenty of choice for renters. At the moment, though, we've got very, very low rental vacancies. And I think most likely you'll see that landlords either choose to sell or they will try and pass on those costs to renters, which they may have more success at this stage in the cycle when the rental market's already very tight. And this is sort of, talking of Aussie slang, there's basically a stoush in the media. People say that, the property council say, well, this is going to end up with landlords essentially trying to pass on these costs to renters. But the Victorian Council of Social Services is saying under no circumstances should that be the case. And there's all this back and forth. And I think, as some people have pointed out, new landlords or new investors, they don't have to invest in Victoria if they're going to do residential property. They might look at, say, New South Wales or Queensland instead if the land tax pushes them away. So I guess that's the big picture. Did you catch any more on that story at all?
Yeah, I think that what's interesting about this is, so a lot of people maybe who don't invest or maybe are yet to invest probably don't realize the holding costs of an investment property. And so this is basically just widening that so that you pay more of a general land tax on a lot of the things that you have, holding in. And I think what's interesting about this, Pete, is it relates back to that question because there is a trade-off, as you say, not just in states, but also in asset classes. So people could, like you and I are well-versed in this, people could choose their additional dollars or their incremental savings from here on out, maybe it goes somewhere else, and that only exacerbates the rental crisis. But you made a mention there about passing on the costs. We still live in a capitalistic world, which because we know it works. And at the end of the day, unfortunately, in Australia, this is just my opinion. Renters are price takers, not price makers. So until we see that dynamic balance, I would only assume that this type of thing increases the cost for renters. I was chatting to someone this week who had 3 investment properties, and he was obviously very frustrated by this. And he said, "Well, I can't afford it." So he's actually looking at selling them now, just because he can't afford the ongoing costs, and he's worried about more regulation coming. So that's my kind of anecdotal sample size of just a few from speaking with people this past week. But I don't know. Simon Kustermark was on the show recently as well, and he said that one of his, from a demographics perspective, one of his insights is probably that we'll see more of this type of thing happen. I don't know if that's fair, but was kind of what I got from that podcast with Chris.
I think the thing in the current environment is, an additional 0.1%, even if you've got, let's say, $500,000 of land value that's taxable. Look, it's $500. It doesn't sound like a lot, but then you've got a $975 fee. But I think the thing is, the current environment is you've seen mortgage rates. Most people in Australia either on short-term fixed rate mortgages, or most people are just on variable rate mortgages. So the mortgage cost has gone up very, very sharply from a year ago. You put this on top, things like repairs and maintenance, well, those costs have gone up as well. So yes, rents are rising, but I think one of the things, as you just pointed out, with resi property, there's always bits and pieces of costs that people don't necessarily take into account when they first buy. There's things like insurance policies for landlords that you have to renew each year, things like rates and repairs and vacancies, and it all chips away. And this is just another thing on top of everything else, which is, as you said, some people will they've seen their mortgage go up and now they've got this additional cost, and some people will be tipped over into selling. But I think some new investors might just decide it's not for them and they're going to look elsewhere. This kind of feeds on, I guess, to the question. So chap who's got 5 investment properties with his wife, aged 34, with 2 young kids. Properties are all freestanding houses, Geelong, Ballarat, and a place of residence in Geelong. So I guess the question is, the original plan was clearly go hard into investment property and then at some point retire the debt and live off the passive income. But now thinking, well, might just be better off selling up the properties and going into ETFs, because you can get passive income from dividends. And in the current situation, pretty strong passive income for the numbers provided. And yes, so circling back to the question, is this something I think about? Well, I suppose let's just talk in very general terms to begin with. I think it's fair to say that residential property is not a good asset class for generating passive income for the aforementioned reasons. There's always little bits and pieces of costs. There's property management, all the other things that we mentioned just before. And even if the rental yield is, let's say, for the sake of argument, around 4%, by the time you've taken off all those other costs, even a mortgage-free property is not a very tax-efficient vehicle, and it's just not a very good way to generate passive income. Commercial property, to some degree, might be a bit more of an appropriate vehicle. Resi property is really all about growing your equity and growing your net worth. Now, the stock market, which is more your area of expertise than mine, but in Australia in particular, the dividends can be quite strong. We've got dividend imputation and franking credits, so it's a very tax-friendly environment for people wanting to generate a passive income. So I would say if you're looking for a passive income in the end game, that's actually a better vehicle for most people.
Do you find that people start like this scenario here? Do you find a lot of people start in the property to leverage up that equity, that net worth, as you say, and then slowly make that shift across?
Transition. Yeah, for sure. Yeah, absolutely. Now, there's different ways to do it. Some people like to sell some of their properties and retire the debt. and keep the others. Some people just get out of property altogether and go across into stocks. My personal experience, and I've been coaching for a dozen years or so, I think people actually find it quite difficult to go from property into stocks quickly, because it's a different asset class. You've got more volatility. Some people just aren't used to watching the daily swings and arrows of fortune that you can get in the stock market. So it often makes sense for people to transition slowly, or at least build up an awareness and a familiarity with how the stock market works. I think it's difficult to go from one extreme to the other very quickly. So look, there's no right or wrong answer to this question. I think there's sometimes a good argument to do both, some property and some shares. I think my best guess is that some of the land taxes will be passed on to higher rents in Victoria over the next couple of years. But yes, I think it's really down to personal choice. Do you want to get the passive income sooner, in which case you might switch across to the stock market? Don't forget, if you're selling investment properties, you do have capital gains tax to pay, which might work out it depends on your personal circumstances, but it often works out to be around 20% or so. So that's a painful hit to take. And sometimes people like to try and defer that until later in the piece. So it's really a numbers game, and there's no right or wrong on this. But this is indicative of the issue at hand, is that some people are thinking, well, if you're going to keep making it harder and harder for landlords, I might just go and do something else. There's been a lot of changes to tenant rules as well over recent years, which have generally been in favour of the tenants over landlord. Yeah,
it has. And let's be real, like this is probably, even though we're talking about Victoria here, something that people right around the country will be experiencing to one extent or another. So it's something that everyone should keep in mind. Like so on my side of the fence, typically with like the outside of property, we see this with the superannuation environment too, where regulatory change is one of those things that's constant. So it's something that everyone should be mindful of the longer their investment horizon. And as you said, it's not all or nothing, which is really important. I think that a lot of people do become quite tribal or parochial, where they think this is my thing and this is what I do. Hopefully we can get the message across that it's a very broad wealth creation strategy. And Pete's first book, I think it was your first book, Pete, Get a Financial Grip, was really like insightful with this as well. So
it's one of the more frustrating things, actually, is the regulatory framework changing all the time. Queensland is particularly changeable on this. It seems like every month we've got a new idea of whether it's land tax or changes to tenant rules, and they're always throwing ideas around. And these are asset classes where in real estate, you're really trying to make a 10-year decision. It's very difficult for people to make a commitment if they don't even know what the rules are going to be next month, let alone in 10 years' time. So it's not really helping. We've already got chronic rental shortages in parts of southeast Queensland, and changing the rules every 5 minutes is not actually helping people to invest and add to the rental supply. So anyway, so I think there was always going to be a tax hit of some sort to balance the books in Victoria, and it looks like property investors in the firing line this time around. So I guess this story will continue, and I think it's a bit of a watch this space as well, because New South Wales will have some significant decisions to make, new government there. A lot of campaigning about maybe shifting away from stamp duty and towards land tax. So we'll have to see how that one plays out as well. And
this is actually a great segue into our next talking point, which is
do love a good segue. We try at least to make these things seamless, but it doesn't always work out.
No, build to rent, which is a topic that it seems to be now finally starting to catch on, Pete.
Isn't it just? Yeah, it's. I subscribe to a number of newsletters, and it seems like every morning I open the inbox and it's another player coming into the space in Australia. So this kind of makes sense. We've got a shortage of rental properties. The federal budget changed the foreign withholding tax, so that means investors from overseas might come into the space. But let's just start at the high level. If you're not familiar with what the concept of build to rent actually is. So typically in Australia, what developers have done is they'll build a new development, whether it's a block of units or something of that nature, and they'll sell off the individual apartments. They're often sold off the plan. And historically, foreign investors have bought a fair chunk of those, less so recently. But the build-to-rent asset class is something that we've seen a lot of in Britain over the past 10 years. And that's generally where you get big corporate or institutional investors. They're building a development, and just as the name implies, to rent out on longer-term leases to private individuals. So typically, you can get for example, a 3-year lease. You can sign up with a corporate landlord, and if it goes well, you should get a high-quality product, responsive to repairs and maintenance issues. And the main thing is you're getting security of tenure. One of the big complaints in the private rental market is if the landlord changes their mind, or if there's a change to the budget, for example, and they decide to sell up. Well, that's really unhelpful for a family if they're trying to rent in a certain school zone, or they're trying to build a life. Our corporate landlord is planning to own these assets for 10 plus years, so you shouldn't have those same issues. So in theory, it should work pretty nicely for people who want to rent for, say, a 3+ year period.
Pete, you've mentioned the UK experience here. Are there any things, like, would you say that's been successful there, the build to rent move?
I would say it's been mixed. I think, it's growing exponentially. So I think at the last count, there's about 80,000 homes or so. But if you include what's under construction and the future pipeline, you're getting close to 250,000. And if you actually, I suppose in the context of a 70 million population, it doesn't sound much. But if you look at the flow of new homes coming onto the market, it's probably about 20% across the UK. And in London, it's very high, near a 40% going forward. So, it's becoming quite significant. I think for some people, it's worked well. I think it doesn't always deliver what people expect, though. The average rents tend to be actually higher than what else is generally available on the market, partly because these are newer properties with good amenities and so on. But also because, don't forget, an institutional investor, they really want a double-digit return on their capital to compensate for the risk of development. So they're probably wanting, an initial rental yield of, say, 4%. And just as an example, I was tracking a build-to-rent development in Manchester in the UK that I was interested in. And this one's called Duet. And they were saying, I won't mention the developer, but the initial rental yield was around 3.5%, and then it went up to 3.9%, and they're expecting it to go up to 4% next year. And this is one of the things that makes housing attractive as an asset class, is that the rents can go up with inflation, and they are doing. So it's not necessarily the silver bullet to affordable rentals, because the corporate landlord, of course, needs a profit. They need a return on their money. So they're not really incentivized to provide much at the lower end.
When you think about it from the developer's perspective, they're taking all of the risk, right? If you think about the duration at which they have to have their capital, their money exposed, they've got to build it, then they've got to rent it, versus, say, if they just build it and sell it, which it gives them a lot more control, I would seem. So, and that's why I asked that, because I feel like it's quite a challenging thing to do in practice. There are so many puts and takes. And if we look at the commercial experience, commercial property, that is, fixed increases typically based on CPI or whatever. And those can be quite onerous because of the risk involved for the landlords. So,
I think from what I've observed, I think that there's a lot of developments in Australia that are proposed that are relatively small, but often I think to make these things work well, they need to be done at scale. Ideally, probably 500 plus units in a development, or maybe 1,500 in a precinct. I think then it makes it a bit easier to get some scale and leverage behind the project. I think sometimes with the smaller developments, it's harder to make it all stack up. And look, so there's been some downsides as well. I think the main one is really just the total ignorance of social housing. There was a situation in London in Elephant and Castle where there's a big build-to-rent development going in, but 4,000 social housing units were demolished. And it's like, well, yes, okay, we're providing new housing supply here, but what about the waiting list for social housing, which is for it's been an ongoing challenge in Britain, just as it has in Australia. So I think, yes, that could be an issue down under, because the appetite to develop in the public sector, there was a period where it was done under the Kevin Rudd government during the GFC stimulus, but really we're just not building much on the social housing side. And I think that's a potential risk if we ignore the affordable rentals in the big rush to provide this sort of upmarket build-to-rent stock.
And we did hear, and Chris and I spoke about this a couple of weeks ago, that the Aussie government, the federal government, is looking to stimulate as much of this as possible through what seems to be an alignment between federal, state, and local governments, and potentially giving more power to states in order to align those incentives to unlock land and get them developed for these types of projects. Where do you see a lot of it, I guess, coming? Like, are there particular locations or states that might be exposed to this more than others?
Melbourne will be the leader initially, and to some degree Brisbane. Sydney is sometimes harder to get these projects to stack up because the land prices are high. But if you look what's already sort of proposed, Macquarie Park, Stockland are going to develop there, Greystar. So some of these overseas institutions, places like Fitzroy, Kensington in Melbourne, and also a little bit in South Australia and Brisbane as well. I think if you look, if you're looking at a share of the pie, probably Melbourne will get about half of the build-to-rent stock, and Sydney and Brisbane will be much of the rest. Brisbane is probably a bit of a smaller market. In Sydney, it's a little bit harder to get these things up and running. So I think Melbourne will be the main one. In terms of locations and product type, there have been some examples in the UK of taking existing dwellings and converting them, but they've been harder to come by. So mostly we're talking new tower blocks close to transport hubs where zoning development might be a little bit easier, and there might be a bit more sort of capacity to build big developments. And we'd mostly be in the unit space. There's been less done in sort of the townhouse and detached house space because that's harder to do at scale.
I remember taking the bullet train in Tokyo one time on the way to the ski fields, and it was half an hour out of the city. So I'll let you do the math on how far out we were. And you'd look from the train line and you just see 3 or 4 story buildings as far as you can see. And they all just kind of gather around these train lines and these hubs that connect through the city. I'm not to say that Melbourne or Sydney or anything's going to be like that, but you can see how these things form through time, right? And those are the areas that make a lot of sense. We've got connections. The land is readily available to go up, which is quite interesting. So I think it's kind of like a watch the space.
Yeah, definitely. And it will take off. In the UK, it's taken 10 years, but now we've got a really big pipeline. Australia, it's still early days. Probably over the next few years, we'll start to see more of these developments, but not big numbers. But I think a useful way to think about it, though, is if you think back a decade ago, a lot of developers were building really small units for renters, but they were being sold mainly to investors, non-residents, people from mainland China. There was a lot of investment from China. I think this is going to replace that because the foreign investors are basically taxed out of the market at the moment. So that's going to be replaced by, well, if you look at what's sort of proposed and being talked about, Stockland and Macquarie Park, Mirvac wants to build 5,000 units, Lend-Lease, I think Scape have mentioned they want to do 10,000, Coronation at Erskineville in Sydney, and then we've got people like Greystar, Sentinel, and some of the overseas institutions. So if you add it all up over 3 or 4 years, we might start to get some meaningful numbers through. But to some degree, it's only going to replace what we used to build for investors but funded instead by, I guess, private investors from overseas largely.
Maybe good news if you're a tradie as well.
Well, that is one of the interesting questions is actually, have we got the capacity? There's building and development companies going bust all over the place. We've got big infrastructure projects as well, and some resources construction. So yes, we can approve a lot of stuff, but at the moment, materials costs are high. There's shortages in the trade space. So actually how quickly we can build is a whole other question as well. Yeah, plenty going on, that's for sure, and definitely I watch this space.
And the third story, Pete, is about the low housing stock. I asked you off air, how do I pull this data? And there are different ways to do that. But it would seem that the total property listings in Australia are at more than a decade low, which would maybe help to explain why prices have been resilient across the board. And I just think this is a fascinating thing. And Chris and you and Chris and everyone on this podcast has talked about it, actually, how in an environment like this, we would see a constrained supply, and the impact that could have on prices means that a lot of the forecasters were probably a bit off the mark in terms of their predictions for property prices. How do you see this falling?
The interesting question is why aren't people selling? Why aren't they listing? I suppose at one level, we've still got essentially full employment. Unemployment rate is 3.7%. For landlords, it's pretty easy to find a tenant at the moment, and rents are going up 10, 20%. So there's a lot of people who aren't forced sellers. I was chatting to Cameron Cusher this week, and that's another episode that will go out. So I won't do a spoiler on that, but he did make a good point, and that is that often people don't want to sell if they can't find something else to move into, and the market can get a bit gummed up. People are actually a bit afraid to sell and find they can't get back in or can't find an appropriate place to move into. Now, there is a seasonality thing as well, because normally we have the sort of spring selling season in Australia, and May, June is not typically a big time of year for listing. So maybe there will be a bit of a pickup as the year goes on. I think one of the really interesting things as well is that you would think as the population gets bigger, you'll get more properties for sale, just on a numbers basis. But as we said, we were looking back at the numbers from 2011, 2012, practically double the number of properties listed as compared to today. So you can argue about why that's the case. I think stamp duty is a big part of it. I think prices are higher. The cost of actually moving quite significant now. A lot of people would rather just stay in place and renovate if they can. And I think certainly one of the points that Cameron raised was, well, the past decade, we've had a building boom. A lot of first home buyers went into new apartments, and there's actually less going on in the second hand or sort of resale space. So there's a few different factors, but I think at the moment, it's a bit of a Pavlovian reaction. Every downturn in Australia has been followed by a boom. And I think a lot of people are like, well, if prices are off their highs, I'm not going to sell. I think it could be as simple as that.
Do you have data? I'm sorry if I'm catching you off the top of your head here, Pete. And I know it's late/early where you are. Do you have any idea around like how often a property comes to market?
Yes, yeah. CoreLogic actually have done some really good research on this, and people are now staying put for longer or owning properties for longer. So not just owner occupiers, but also investors. It's more so the case for houses, where people will generally own for around a decade now. But actually, even for units and apartments, the average hold period, especially in the big cities, is getting on towards a decade. So people used to sell more often, but now people are taking a longer term view. I think the transaction cost would have to be a part of that. I think stamp duties were designed with much lower property prices in mind, but governments say it's too much of a good thing. It's hard to give up those juicy taxes, and the stamp duty keeps on climbing, and there's not much pushback against that. I think a lot of people are discouraged from buying and selling too often now, because the cost of doing so can be quite punitive.
Yeah, that's what I was thinking about, is like how we've stretched that holding period and the impact that has on listings. Could be meaningful because, and let's be honest, a lot of people that buy quality properties probably don't want to sell, not just for the frictional cost, but they probably just are happy to accumulate in what we've had historically, at least a low interest rate environment. So interesting. I find this really interesting because it's not like, say, like we mentioned ETFs before from my side of the fence, where you just create more units and you add more, right? And there's no problem with that. Whereas we can't just do that. We can't just switch it on and off, right? As we've discussed. So I feel like this could be interesting to watch over the next 2 to 3 months and see if this is, in terms of seasonality, does start to bounce back, or if people continue to hunker down and avoid that frictional costs.
One of the big narratives that we've seen over the years is that when you get a downturn, there's a rush for the exits, and then that really exacerbates the downturn, and then the shit really hits the fan. But we just have not seen that. I think we're not in a deep recession situation. It's not like it's we talk a lot about recession risk at the moment, but not every recession is 2007, 2008, 9. Some recessions are shallow. At the moment, employment's at a record high. So it's not like we've got hundreds of thousands of people being punted out of work or anything like that. And most people are hanging on. I think there will be some people who come under mortgage stress, no doubt, because mortgage rates have gone up and so quickly. But at the moment, anyway, most people are able to hang on, and most people are choosing to. So definitely one to watch. But at the moment, not many forced sellers.
And I think it was last week where you talked about, it may have been last week, where you talked about unemployment and the potential for that to roll over. And that could be an interesting number to watch as well, because if that seems to be a bit of a linchpin in maybe in some of these numbers where we get the stress, maybe it becomes severe stress. But interesting to watch, very interesting to watch this one. This is probably the most interesting of the 3 stories for me, Pete, to be honest. In the short term, at least. Longer term, build to rent is a fascinating story that I'm going to watch very closely as an investor on both sides of the fence.
Yeah, a lot of people talk about mortgage stress, but the number one indicator of mortgage stress is whether or not people have a job. Most often, people don't default on properties and mortgages if they're fully employed. But if you lose a job and you're finding it hard to find a new one, that's when the stress really builds. And at the moment, that's not an issue. But we've got immigration picking up now. The economy is slowing, certainly. So definitely something to keep an eye on as the year goes on. The forecasts are always pretty rosy, but things can change pretty quickly.
Absolutely. So, Pete, we've got 3 big stories from this week, which is the land tax changes, not just in Melbourne, but I guess people are mindful of regulation generally speaking. We've got the build to rent pipeline. It's interesting to hear your experience in Britain and how that may apply to the early days of what we're seeing seeded in Australia. And of course, the low stock and listings that are available on the market. I love it listening to these updates every week, Pete. I find them so interesting because it gives me a real world perspective of what's happening in the economy.
Yeah, I enjoy doing them too. Yeah, it's always good to keep an eye on what's going on. And of course, there's never any shortage of property news stories to trawl through in the media. So it's not like we're short of subject matter. But that having been said, we do like to get your feedback and questions. So do check out the show notes, send in your questions, and we'll try to address those the episodes as we go forward. So we get some good comments and feedback. So keep them coming.
And you can find Pete at Pete Wargent on Twitter. Great follow, and Pete Wargent blogspot as well. Follow him on Twitter. It's where I get my daily economic updates, mate. I've got to admit, I love it. So you'll find all the links in the show notes. If you are listening, if you haven't already got in contact with Pete, reach out to him. He is a rare unit, so he does. he does.
Eclectic news feed, yes. It's not all property and finance. I often find myself typing replies and comments, and then I think 3 times and then delete. It's nothing good comes of that website, but it's all good fun. And yes, and don't forget, you should definitely subscribe for the Rask podcast on your favorite podcast player. And of
Absolutely.
course, these go out on YouTube as well, so definitely check us out there.
Yeah. Jump on YouTube and have a watch if you want to see our heads for radio on YouTube. We'd love to see you over there. But mate, this is great fun. So thanks for having me on this week.
Pleasure. Cheers, mate. Talk soon.